Hello and welcome to a new week for the Quantaraxia's market dashboard, where equity markets are looking good. Everything looks rosy at this time, but not so good under the hood if you look at the economy and the market structure itself. And for that, you'll have to check the Croissant Files newsletter, the weekly Croissant Files newsletter, where you will be able to find the link below in this video's description. But we'll take a look at that, so let's go. So overall, we are in a situation where risk on assets going up, risk off assets slightly going down, maybe except gold, but gold is a function of the US deficit situation. We know that nothing is under control at this time, so it's not totally surprising that even in a risk-on environment, gold can still climb at this time. We also have the average activity ratios for all these major assets that is slightly on an uptick this week, but starting from a very low level, so nothing concerning at this time. Same thing about, if you look at the S&P 500, despite here we are hitting new highs, the volatility is crushed, the VIX is crushed, so everything seems to look good at this time, when we have other indicators that do not show any stress in the market at this time, such as the average pairwise correlation. We are still at quite low level currently. And if we look at equities specifically, this was a pretty good week for equity. Everything is going up, from US equities, European equities, emerging market equities, the Euro stocks. The volatility is crushed again. So everything seems to be looking good at this time. However, if we start looking in detail, we still see the same problems. The S&P and the indices are pulled by the tech sector. It's easy to see when you look at the Qs going up, when the industrial companies, in a broader sense, and the small caps are still struggling, which indicates pretty large concentration in the tech sector, which is confirmed by another study by Societe Generale. Here we were showing the difference between the S&P 490 and the top 10 stocks in the S&P 500, which are tech companies. Anyway, so huge concentration. That means that the market is more at risk, and we do not get any kind of diversification for maybe at least 400 of stocks that are totally useless to consider in the index right now. Now, looking at the VIX seasonality, it's a little bit interesting because specifically at this time of the year. So if we look at what happened so far this year, the pattern is pretty consistent with historical evolution of the VIX over the year, slightly going up until March, the first quarter. Then we have the kind of anomaly linked to the tariffs crisis, I would say, in early April, and then revert back to the regular yearly trend. Where we are now is that we are near the bottom of the seasonal pattern, which is end of July, beginning of August, where usually historically volatility has started going up progressively, and we know that August is always a little hectic, specifically because of the reduced liquidity in the market. And September is often a little bit hectic as well. Before, even October can be sometimes concerning, but before the volatility is reduced again by the end of the year for the traditional end of year rally. So this is where we stand right now. So it would not be totally unexpected if from now the market is a little bit more difficult to anticipate with a little more volatility. Now looking at the greed fear index, again going back to what I was saying before, if we don't look under the hood at what's happening actually in the economy, at the market structure, we cannot really see that the situation is not as good as we may think it is. And another indicator such as the greed fear index, the one that I built, but I've checked with other ones that I've built by other people and other companies, that so far at this time their greed fear index is about neutral at this time, so, and doesn't reflect, in my opinion, the risk that is in the market at this time. Now, if we look at bonds, everything may seem okay, especially in the context of a risk-on environment. It's not totally surprising that risk-off assets are struggling a little bit more this week. However, that would be true in a context where the correlation between bonds and equities is negative. The historical negative correlation that we've been experienced for a couple of decades right now, but we know that it's not true anymore, specifically for the last few years. And so what we can see it specifically in the inflation protected treasuries tip, which is progressing this week, which may indicate that bonds going down this week and interest rates going up might actually be more the results of concern about future inflation than actually a risk-on environment. On the crypto side, we see nice progression this week, whether it's Bitcoin or other altcoins. Bitcoin's only 1.2% below its all-time highs. On a weekly basis, all-time high is at 118 only, not 123,000 and some, like we've seen on a daily basis. But however, it was a pretty decent week for altcoins, specifically, which many expect, I would say hope, for a finally altcoin season, after altcoins have been significantly underperforming Bitcoin for quite some time now. If you look at the distance from the all-time highs, they are much higher for the altcoins than it is for Bitcoin specifically. But I think that another point that is really interesting about the crypto sector, the crypto asset class, is specifically about Bitcoin, because this is the main one used by more institutionals rather than other altcoins, is that the volatility is dropping at this time, which again means for investment managers that are doing some form of risk adjustment in their allocation, having a lower volatility for Bitcoin means that they would increase their allocation to this asset class. Of course, in terms of risk management, there are some limits to some specific allocation to specific risk asset class, though that may not actually transfer into actual more allocation into Bitcoin. But for the ones that are pretty loose limits on what they can allocate to cryptocurrencies and specifically Bitcoin, these ones may increase their allocation. Thank you for joining the Quantaraxia's market dashboard this week again. I strongly encourage you to check the video's description below and the link to the Croissant Files weekly newsletter. That is the perfect companion for this video and market review about geopolitics, economy, and market themselves, which goes into much deeper detail than what you can expect and what we have the time to do here. So thank you again for being here, and see you next week.